Financial analysis of supply chains. In this lecture, we're going to talk about how to analyze the performance of a supply chain based on financial data that is reported in the annual financial statements submitted by public companies, which is companies traded on stock markets. That will be the majority of the lecture, and then at the end we will also study key performance indicators for different areas of supply chain management that can be used within a company internally to keep track of their performance, and we will also look at relationships between these performance indicators. Okay, so the learning objectives are to describe key financial measures of firm performance, understand how supply chain decisions can actually influence the financial performance and the stock market performance of the firm. Then we learn how to calculate some of these financial metrics, and then we talk about performance measurement in general in the supply chain. And for the last part, we will take the perspective that we are working within the company, so we have access to more fine-grained data about the company's operations. So why do we care about financial performance and looking at financial statement data? Okay. We might want to evaluate the performance of a company over time because we either work for the company or we are responsible for the company, or maybe we invest in the company. Maybe the company is our competitor and we are trying to see where they are going with respect to the rest of the industry. Okay. We can use it to understand differences between two companies or two supply chains. This can be really powerful because a lot of differences and similarities can be found between two supply chains just by looking at publicly freely available financial data. This can help us benchmark against other companies. So let's say we know, okay, Apple has a really great supply chain. We calculate the metrics for Apple and for our company, and then we can see where we are lagging. And when we see the link of supply chain decisions to these metrics, we can say, okay, we are lagging on this metric, and to improve this metric, we have to improve supply chain decisions in this particular area. Here. The other reason actually this is really important is if you are a supply chain manager and you want to undertake an initiative to improve the supply chain performance in your company. The CEO of the company or the top management is usually evaluated by the board of directors or by the shareholders on how much they contribute to the market value of the firm. Do they increase the share price or not? And so if that is the worry of the top management and a middle manager comes up to them to try to get their support for an initiative or an investment in the company's operations, if this middle manager can make a case that if we do this investment, this is how much the company's economic value or return on investment will be, and this will lead to increase in the share price, then it will be an easier sell. It'll be easy to get the top management on board for such an initiative. So this is very useful because you can then look at your actions as a supply chain manager and then relate them to the ROI, return on investment, economic value add, the stock price of the company. Let's look at the first section, and that is going to be financial performance and its drivers. Okay, so let's look at our model that we're going to use to evaluate financial performance. Okay. So if you look at the blue boxes, we have stock price on the right hand side, then which is the stock market performance, okay, an increase in stock price. Then we have the company's performance, which we measure as return on investment, and that is kind of related to economic value add. I'll talk about how we can use ROI in a way that captures the idea of economic value add. Okay, ROI is determined by profits and capital employed. Okay, profits are in turn determined by revenues and costs, and capital employed is made up of fixed assets and working capital. So in a way, revenues, costs, fixed assets, and working capital are the four key drivers that, if managed properly, can lead to higher profit for a low level of capital required, and that means a high return on investment. So how can we measure our performance on each of these drivers, these value drivers? Value drivers meaning if you improve on them, you improve the value of the company. So we're going to use one metric for each. The metric for revenue, for doing well on revenue, would be revenue growth. So if a company is able to grow the revenues, it's performing well. It's trying to drive value through the driver of revenues. Operating margin is how much profit a company makes per dollar of sales. So if your operating margin is, let's say, 10%, then for a dollar of sales, 90 cents are going to use to pay for various costs, and 10 cents are going to be your operating profit for that sale. Now we are calculating operating margin using earnings before interest and taxes. EBIT, or EBIT as it sometimes is called, stands for earning before interest and taxes. Why is that? Well, our perspective on all of this is the perspective from a supply chain perspective, and a supply chain manager, at least in theory, does not have a lot of control over interest expense of the company and the tax expense. The interest expense is a function of a capital structure of the company, and you learn more about this in your finance courses, but essentially it depends on how the company is financed, how much debt it has, how much equity it has, and usually those decisions are made by the chief financial officer. So those decisions are going to determine the interest expense, not really the supply chain manager. The supply chain manager decisions are going to increase or decrease the working capital, and if the working capital is being financed through interest, they could increase the interest expenditure indirectly, but directly the supply chain decisions don't have full control over the interest expense. Same thing for taxes. In theory, taxes are externally determined. The legal environment or the government determines taxes on the company, and a supply chain manager may not have a lot of control. In practice, though, oftentimes companies get tax advantages to open up a facility in a particular city or state or country. You might be familiar when Amazon wanted to open a new headquarters. A lot of different states were lobbying for Amazon, or cities were lobbying for Amazon to open the headquarters in that city. Okay, and they were giving Amazon incentives such as some tax incentives for a certain number of years. So if there are such tax incentives on offer, they do factor into location decisions in a supply chain, where to open manufacturing plants, where to open retail stores, where to open warehouses, and so forth. And so in that sense, some supply chain decisions are going to influence some taxes of the company, but not fully, right? Okay, so for fixed assets, are we using fixed assets efficiently? The metric we are going to use is fixed asset turnover, which essentially measures for every dollar stuck into fixed assets. Fixed assets are things like machinery, plant, equipment, warehouses, things like that. So for every dollar invested in such stuff, how many dollars of sales can the company generate? And for working capital, we're going to use cash to cash cycle time because it captures very well the whole supply chain cycle, which we'll discuss in detail. And cash to cash cycle is computed by looking at days sales outstanding, DSO, days payables outstanding, DPO, and days sales of inventory, DSI, and we'll talk about what these terms means in the next few slides and how exactly to compute that. Okay. Now, in this diagram, in this kind of tree diagram where 4 drivers, revenues, costs, fixed assets, working capital, eventually lead to return on investment. Okay. Whenever 2 drivers are being combined, like revenues and costs, it does not mean we're going to always add them or subtract them or multiply them. So let me show you how the drivers actually get combined. So to get profit from revenues and costs, we always subtract costs from revenue. So if a company has 1,000 revenue, could be 1,000 millions, the units could be millions of dollars. So 1,000 in revenues, 900 in costs, the profit will be 1,000 minus 900 to get a profit of 100. So revenues and costs are related by a subtraction. The costs have to be subtracted. Fixed assets and working capital are both part of capital employed, so they are related to capital employed by an addition operation. So you take fixed assets, in this example 700, add 300 of working capital, and you get capital employed of 1,000. Then return on assets is related to profit and capital employed by division operation. You divide the profit by capital employed and you get a number. In this case, you get 0.1, and then you can multiply the number by 100 to convert it to the percentage scale, and 0.1 times 100 would give you 10%. Okay, now let's talk about how does ROI, such as a 10% return on investment, relate to economic value add. Economic value add is the idea that a company must make more profits or returns on investment than the cost of raising the capital that the company is using. Okay, so if the company uses, let's say, $10 billion worth of capital or assets to generate some profit, and the cost of that $10 billion based on interest rates and so forth is a certain amount, the company better generate more profit than that cost. Otherwise, it's better to put the 10 billion into a bank or bonds and earn interest, right? The company has to make more profit than the interest you would earn if you invested that much money in bonds, for example. Now, that's a simple example. Usually we don't just compare with the interest rate for bonds. We use what's called the weighted average cost of capital. Again, that is not central to this course. You should refer to your finance courses for what is weighted average cost of capital. But essentially the idea is there's an opportunity cost to money. If I put money in a business venture or company, I could have put the money into the stock market in bonds or some portfolio. Right? So this company better give me more profit than just throwing my money into bonds or stocks or something like that. Otherwise, why do I need to work when my passive investment, just buying some stocks and holding them or buying some bonds, if my passive investment strategy is going to give me more money, why would I bother with waking up every day, running a company, and going through all the hassle, right? So the economic value add idea is you take the profits of a company and you subtract the cost of investment, the opportunity cost of the investment in the company, and the remaining amount should be positive. That's the real profit, because some part of the profit you could just have earned through passive investments. So if you earn $10 of profit and the money you invested could have earned $3 in passive investments, then you've not really earned $10, you've really only earned $7, because $3 you could have earned anyway through passive investments. That's the idea of economic value add. Okay, so ROI is the similar idea. Let's say for our company, the return on investment is 10%. We can compare the 10% with what we would have received had we invested this money in bonds or stocks or passive investment strategies or something like that, where we don't have to work, right? So let's say the passive investment strategy would have yielded 5% return, and this company gave me 10% return, right? Then this company is valuable because the ROI is more than what I could get in a passive investment. Okay. Sometimes the ROI could be lower than what you may get in passive investment, and people might still invest because they expect the ROI to go up in future. So it's not the case that the moment ROI dips below your cost of capital or something like that, you just say, oh, just sell everything, just get out of this company. No, you obviously have future expectations, and if you think you have a bright future ahead of you, you might live with a low ROI for some years. Now let's do a real example of all of that we've talked about. So we're going to take actual financial statements of Walmart, 2018 statement and 2017 financial statements, to compute all of these metrics and make this tree for Walmart and see how Walmart's supply chain is doing according to these financial metrics, which measure the four value drivers. Okay. So the first value driver was revenues. So let's see what's been Walmart's revenue growth. Okay, so if I'm looking at Walmart in 2018 financial year, okay, remember financial year don't have to line up January to December. Sometimes financial year 2018 means it's going to be, ending in June, July or something of 2018, or it starts there and ends in June, July of 2019. Right, so the financial year is what's meant here, not the calendar year. Okay, so in 2018, Walmart, everything is in millions here. Okay, so Walmart had $543 million worth of sales, and that was an increase from the previous year. So we want to compute how much was the increase for. So we take sales at time t, at the current time 2018, divide by the previous year's sales, and then we subtract 1 and multiply by 100. So we take 500,343 divided by 485,873. 500,343 is a bigger number. When you divide a bigger number by a smaller number, you get the answer is going to be 1 point something. Okay, so you may get 1.029, something like that. Then you subtract 1 to take the 1 away and multiply by 100 to convert to a percentage, and you're left with 2.98%. Okay, so 2.98% was the growth in Walmart sales in the financial year 2018 as compared to 2017. Okay, so where did we get this number? 5,343, 485,873. We'll look at the income statement. Okay, and the income statement usually starts with the first line as revenue or sales. Sometimes it says sales, sometimes it says revenues. So the very first line of income statement is the only line you need to look at. We get our numbers from there to compute this metric. Now let's look at the second driver of costs. And here we're going to look at operating margin. What is the profit margin after taking out operating expenses? Okay, so we need to look at earnings before interest and taxes and divide that by the revenue or the sales. So in the same income statement, if you go down the line after certain expenditures like cost of sales and SG&A, you will find either it will say operating income or it will say EBIT, earnings before interest and taxes. And another way you can identify that is that under the EBIT line, the interest expense and taxes will come after that. So EBIT, or operating income, is going to come before interest and taxes. So we can get their latest EBIT, divided by the revenue, multiply by 100 to convert to a percentage, and we get 4.08%. What does that mean? That means every dollar of sales that Walmart does, it makes 4 cents on that sale, and about 96 cents are paid up in costs. Some of it is the employee cost, facility cost, they have to pay their suppliers, all of that. So 96 cents go towards cost, and 4 cents is the operating profit. And then from this operating profit, they still have to pay interest expense on their debts, and they still have to pay taxes and all of that. Okay. Now let's look at the third driver, which is fixed assets. And we're going to calculate the fixed asset turnover, which is how many dollars we can generate, okay, per dollar in fixed assets. Okay, so you'll see that the fixed assets is on the left side, the asset side of the balance sheet. So if you open the balance sheet, you'll have all these assets listed here. You go to fixed assets. Okay. Sometimes it will list it just a number in front of fixed assets. Sometimes it will have a subheading on property, plant, and equipment, and it will be in this case it's 114818. Okay. Sometimes it will list property, plant, and equipment. Then below that it will list depreciation. Depreciation is the expense that your assets have wear and tear. They lose life every year. So, that's the depreciation expense. They depreciate in value. Like if you buy a car, after 1 year, the value of the car has gone down. So there's been depreciation expense, right? So if they have depreciation listed separately, then they would list below depreciation net fixed assets, which will be the starting value minus the depreciation. Right? In this case, the next fixed assets are just listed here, property, plant, and equipment. But sometimes they'll say, okay, $100 million in property, plant, and equipment, and depreciation was $5 million this year. So the net is 100 million minus 5 million, or $95 million. So then you'll take the net after subtracting depreciation. Okay. So here that's already been done. We just have property, plant, and equipment net given to us. So we'll take that, and we'll take revenue from the income statement. Notice revenue is not given on the balance sheet. So we go to the income statement to get the revenue. We go to the balance sheet to get the property, plant, and equipment, or the net fixed assets, whatever it's called in that company's balance sheet. And we divide the two. And here we do not multiply by 100, okay? It's just a division, and we get 4.36, which means every dollar that Walmart invests in stores, warehouses, equipment, that sort of stuff, for every dollar of investment Walmart has made in such fixed assets, Walmart is able to generate $4.3 of sales every year from those fixed assets. Okay. Now, before we also need to figure out working capital, the actual value of the working capital, and then we will figure out the cash to cash cycle time. Okay, we need the actual value of working capital because we have to get the total capital employed, and we also need the cash to cash cycle time. So how do we figure out working capital? Working capital is, inventories. You have to spend money to build inventory or buy inventory. So that's inventories is working capital. Receivables is working capital because that's sales you've made on credit. You've sold goods, but the customers have not paid you yet. So you had to incur cost to produce those goods, but customer hasn't paid you, so your money's stuck up in those goods. So those two things, receivables and inventories, increase working capital. So we add them up, okay? And then we subtract accounts payable because that is money that you owe your suppliers, right? Your supplier gave you product and you have not paid your suppliers yet. So if you have not paid your suppliers yet, that's reducing your working capital because that's free stuff you have for a time period until you have to pay your suppliers. So you take receivables plus inventories minus accounts payable. In this case, these are these three numbers from the balance sheet of the year you're analyzing, the financial year you're analyzing. And in this case for Walmart, 5.6 billion or 5614 million in receivables, lots of inventories, but lots of accounts payable. So the net working capital is only $3.3 billion. So Walmart needs to invest $3.3 billion into inventory and stuff like that to keep the business running. Okay. Now we want to see whether working capital is being utilized, how good Walmart is at working capital management. So we're going to compute what's called the cash to cash cycle time, which is going to be our metric today in this lesson for evaluating how a company is doing on working capital management. Now, cash to cash cycle time, as the name implies, has to do the cycle of cash. How long does it take for money to get cycled in this supply chain? So let me show you this cycle in this picture. This black line, okay, the thick black line running horizontally on the slide is representing the passage of time. So as you move from left to right across the screen, the time is moving on, okay, time is moving forward. The vertical arrows in blue show different events. So let's say we start on January 1st of the year, and on January 1st we purchase raw materials. Okay, so that happens. Now, purchase raw materials means we ask the supplier, we send a purchase order, we say, okay, give us this many raw materials or components. The supplier may take some time to deliver those raw materials and components. Either the supplier has to produce them, or even if the supplier has them in inventory, it's going to take time to transport them to your factory. So the next blue arrow is after a certain number of days, the supplier delivers materials and gives you an invoice. Hey, this is the cost, pay me this much money. Okay. Now, once you get the invoice, you may not pay the supplier right away. Because there's sales terms. The sales terms might say you have to pay the supplier within 30 days or 40 days or 60 days. Okay, so when the product is delivered, the timer starts, and when you actually pay the supplier, the timer stops. This time is days payable outstanding. How many days do you make the supplier wait before you pay the supplier? That's DPO, days payable outstanding. You have payables, you need to pay the supplier, but you're not paying right away. You're going to pay the supplier after 30 days, 60 days, whatever that is, and that's days payable outstanding. Okay. Now, remember, as soon as you received the raw materials and components, they became your inventory. They will be on your balance sheet now from that time. Okay. So, the day you receive the material, see the bottom gray bar, days sales in inventory, that inventory timer starts ticking. Okay. And when you actually deliver the goods to the customer or sell them and the customer actually takes possession of them, then the inventory goes out of your system and it's the customer's headache now. So that is when the timer ends for days sales in inventory, DSI. That's your inventory days. How many days do you have inventory for? That's the gray bar at the bottom showing you from receipt of raw materials till delivery to the customer. The time between these two dates is days sales in inventory, DSI, or days of inventory. Okay. Once you actually, so between receiving raw materials and delivering to customers, your customer order might arrive, or if it's make to stock, like Walmart, you just make stuff and put it on the shelves, or consumer electronics, let's say, you make TVs and you put them in Best Buy, then you just make according to plan. So this could be customer order, or it could be production plan. Okay. So based on that, you start, once the production plan is made or the customer order arrives, you schedule production, then the production actually starts, then the production actually ends, and then you deliver. It's possible that these arrows are close to each other. This is not a typical time. It's just an illustration of what happens first, what happens second. The difference between the arrows would vary based on the company, okay, how long it takes to produce and so forth. Anyway, once you deliver to the customer, okay, the customer might not pay right away. In some cases, the customer might, right? So the customer cash inflow arrow might be right on top, right here on the delivery arrow. As soon as you deliver, the customer pays. Sometimes the customer might pay in advance and the arrow may be to the left of delivery, right? like you book a Tesla, you pay some money in advance, right? So some of the money is in advance, some is at the end, right? So this picture can get complicated. But let's say the customer pays after delivery. So then the time between delivery of goods to customers and customer payment is going to be days sales outstanding, DSO. Okay. Now you add the inventory days to the days sales outstanding. This is how much you have your working capital requirement. Okay, because from the receipt of materials till you receive cash from the customer, either you have to finance your inventory or you have to finance the customer's purchase because the customer hasn't paid you yet. So all of this time below you need working capital for. Okay, so basically your cash to cash cycle time would be DSI plus DSO, which is right, DSI plus DSO right here. Okay, so this is a typo. This is DSO. Okay, DSI plus DSO. Okay, that's basically a working capital requirement. But there's good news. The good news is for your entire working capital requirement, the supplier is going to chip in. How does the supplier chip in? The supplier says, use these components to make the final product and sell it to the customer, but you can pay me after 30 days or you can pay me after 60 days. So the supplier is going to finance part of this journey. And so you have to subtract that out to get our cash to cash cycle time, how long of the cycle we need to sponsor. So we subtract the days payable outstanding, DPO, from DSI plus DSO, and we get the cash to cash cycle time. So DPO is subtracted because that is the supplier's contribution to the working capital requirement. If the supplier said, pay me right away as soon as you get delivery, then DPO would be 0, and so you wouldn't subtract anything. You just subtract 0, which is like not subtracting anything. So let's actually compute this for the case of Walmart. Okay. Now, just note this alternative terms. Days sales outstanding is also called receivable days. Days sales in inventory is also just called inventory days, the number of days you have inventory for, and DPO is also called payable days. Okay, and how do we compute them? We take receivables from the balance sheet, we divide by sales per day. Revenue there's 365 days in a year. If you divide the sales of a company by 365, you get the sales per day or revenue per day. So we first compute revenue per day and we subtract receivables, which is customer needs to pay us back that money. This is credit for the customer. We give credit to the customer. So receivables we divide by sales per day. Okay, so we converted receivables from a dollar amount into a days amount. Okay, and same thing, inventories we divide by cost of goods sold per day. Why not revenue per day? That's because inventory on the balance sheet is kept at cost, not at revenue. So let's say I have a phone, okay, in inventory. This phone cost $300 to make, and I sell it for $600. Because this phone is in inventory, my balance sheet will not say $600 of inventory for this phone. It will say $300, the cost of the phone, not the selling price. Inventory is at cost on the balance sheet. So we take the cost per day, cost of goods sold per day, and we divide inventories by that to get inventory days. Same thing for payable. When you have to pay the supplier, the supplier's cost is closer to your cost of goods sold. It's very far from revenue. The cost of goods sold is a closer estimate, of how much you have to pay the supplier. So you take a cost of goods sold per day, and you divide payables by that to get payable days. Okay, and once you have the three things, you just add DSI, add the first two. Okay, this one, the number you get, you add that to the number you get here, and you subtract the number you get here from that. So let's do an example. Okay, so days sales outstanding or receivable days are going to be receivables from the balance sheet right here. Receivables from the balance sheet divided by sales per day. This is sales over a whole year. So we take the entire year sales divided by 365 first, and then we do the second division, the 5614 over whatever sales per day we get, and we get 4.1. So on average, Walmart gives credit for 4 days to customers. That is because a lot of customers get zero credit, they just pay cash, and some customers will finance purchases like of TVs or furniture, large items, right? And they're financing maybe for 6 months, a year, whatever. And so on average, the sales of Walmart are being financed by Walmart, are being on credit of about 4 days. So customers are on average paying after 4 days. That does not mean every single customer pays after 4 days. Most customers pay in cash or credit card right away. So Walmart gets the money right away, but some customers finance for a long time, so the average turns out to 4 days. Inventory days, you do the same thing. You take inventories from the balance sheet right here. You get cost of sales is COGS is also cost of sales. So sometimes it's written cost of goods sold, COGS. Sometimes it's written as cost of sales. So you could find either term. This number here is COGS divided by 365, and then you take the inventories and divide by the COGS per day, and we get 42.8 days. So on average, Walmart has enough inventory to satisfy 42.8 days of sale. So if Walmart stopped receiving shipments from suppliers, it could still operate for about 42 days in the face of a supply disruption because it has enough inventory approximately for that much. Okay, payable days, you take payables again from the balance sheet, but payables are going to be on the right hand side, on the liability side, because it's something that we owe to our suppliers, it's a liability for us. So you take that number, and then you take COGS per day, and you divide this number of payables by the COGS per day. And we see it's 45 in 2018 for Walmart. So Walmart is paying the suppliers 45 days after it receives goods from them. So we compute cash to cash cycle time from Walmart. So we add this one, DSO plus DSI, and we subtract the payable days, and we get 1.84. This means Walmart has very low working capital requirements because Walmart only needs to finance its working capital for 2 days. Why? Why is that? Because suppliers are doing most of the work. Suppliers are being so generous to Walmart. Walmart has a lot of negotiating power, perhaps, that Walmart takes stuff from the suppliers and it sells the stuff, and then it pays the supplier back really late. So the supplier is financing the inventory and sales of Walmart. Now, this number, cash to cash cycle time, can be negative. Okay. In this case, the supplier is not financing all the working capital requirement of Walmart because Walmart has to, the net is about 1.8 days. So Walmart is a positive, it's plus 1.8 days. So Walmart has to finance for 1.8 days worth, right? But if the supplier payment terms were, let's say the supplier could be paid after 60 days and this number was 60, right? Then this number would become negative because 42 plus 4 is going to give you 46.8, 42.8 plus 4, 46.8. And then 46.8 minus 60 would be like negative 13 point something. That is possible. The smaller the cash to cash cycle time, the less the working capital burden on a company. Okay, so if it's negative, that means the company is entirely financed by the supplier. They don't need to have any working capital really of their own. They're really running on the supplier's money. Now that's not always good though, right? Because if you push all of the working capital burden to the supplier now has a huge working capital burden because you just shifted it to the supplier, and the supplier will have to finance the working capital by getting debt or some sort of financing, and the supplier has to pay interest or some expense on that financing. So if you have basically increased the supplier's cost and you've decreased your cost, you've kind of moved your cost to the supplier. If you're reducing cash to cash cycle time by having huge value for payable days, you're paying the supplier late, if that is the case. When you increase payable days, you move your working capital cost to supplier. Okay, so that's not always a good thing, because what will the supplier do after some years? It will eventually increase its prices, right? Because you increase the supplier's cost, the supplier cost will eventually be built into the pricing of the supplier. The supplier may not immediately be able to increase its prices because there's agreements and contracts and negotiations, but eventually over time the supplier will keep trying and slowly get the price increases, because you just increase the supplier's cost. However, if you did not decrease your cash to cash cycle time simply by increasing payable days, what if you reduced your inventory? You became more efficient and you have less inventories now. Less inventories means a smaller cash to cash cycle time. Then that is really good, because you did not push your cost to the supplier, you just became more efficient. So it kind of depends on how are you decreasing cash to cash cycle time. Now let's put all this together for Walmart. Okay, so our revenue growth 2.98% right here, operating margin 4.08%, fixed asset turnover 3.45. This is the dollar in sales generated from $1 in fixed assets. Cash to cash cycle time 1.84 days. Our revenues minus costs were EBIT, earnings before interest and taxes, were about 2437. Everything is in millions, which is about 20 billion, 2437 millions. Our capital employed was fixed assets and working capital, which was 123 million. So we divide EBIT by this and we get a return on investment of 17.3%. Notice this is pretty amazing. Remember when we looked at operating margin, this seemed kind of low. We were like, oh, Walmart only makes 4 cents on a dollar of sales. But because it's so efficient in its operations, its return on investment is so high. So it has a high operational efficiency. So that's a very good ROI, right? Bonds and passive investments might not give you that much return per year. So it's a very good. The company's adding economic value, actually, right? It's generating economic value. Okay, now remember, this is not the ROI that you would compute in a finance class, because in a finance class, you'll probably take net income. You'll subtract interest, you'll subtract taxes. Here, you might add other types of assets as well. For example, if you go here to the balance sheet, we were not concerned with intangible assets. Sometimes there's goodwill on the balance sheet, and I don't want to go into what those things are. You should learn that in the finance class, but essentially they're not directly impacted or controlled by supply chain. So supply chain manager is not directly controlling them. So this is all from the perspective of supply chain, looking at the things in the balance sheet and income statement that supply chain decisions can control, and then kind of looking at the ROI, which is relevant to the supply chain's performance. So these measures reflect the supply chain performance. They don't reflect the performance of the financing team. They may be able to get cheap funding for the company and stuff like that. They don't reflect the performance of some of the other areas of the company, right? From a supply chain perspective. So that's a very good ROI for Amazon. Okay. Now let's talk about what supply chain decisions are actually going to impact these 4 drivers of revenues, cost, fixed assets, and working capital. In other words, what supply chain decisions can I take to increase my revenue growth as a supply chain manager? What supply chain decisions I can take to increase operating margin? What supply chain decisions I can take to increase fixed asset turnover, right? If we understand that, then this nice picture gets linked to the decisions of the manager, right? And then the manager working every day can say, okay, if I do this is how the drivers will be impacted, which will then lead to ROI being impacted, which then eventually impacts the stock price. Okay, so revenues, what can supply chain do for revenues? Reduce stockouts. Customer comes to buy something, it's not in stock. Well, you hurt the revenues, right? So inventory is managed by supply chain, so you have to reduce stockouts. Shorter lead time. If the customer has to wait, you're going to customize something for the customer, like the customer comes into a furniture store, picks a sofa, and they pick a color they want, and then you say, okay, it's going to take my manufacturing and supply chain people 2 weeks to set the sofa up for you, make it for you with this cloth, and then we'll take 1 more week to deliver it, and so you have to wait 3 weeks. Well, if you can cut down your lead time to the customer or your response time to the customer's order, customers will be happier and may get more customers and more revenues. Better customer service, right? A lot of aspects of customer service are controlled by supply chain and logistics. And in the logistics course that is taught, at least when I teach it, I go a lot into how does logistics and supply chain impact customer service, right? So I'll refer you to that for more details. And pricing, right? Well, pricing, you might say, well, marketing or general manager is involved in pricing. True, but if you're able to reduce your costs, they have more flexibility on pricing too. And depending on in the industry and the context, depending on price elasticity, less prices may mean more revenue. Okay. Also, innovation and time to market. So for new products, new models of your products, how quickly can you innovate? Well, a lot of innovation has to do with taking a prototype to production. Right, you have a prototype or an idea, and the prototype works in the lab, but you have to now produce it cost effectively. So the production team, the supply chain team is going to sit together and going to figure out how do we make this thing in a cost effective manner, even though the prototype is done. So the faster they can do that, the faster the company can bring more innovations to the market. Time to market, once a product design is ready, how long does it take you to produce and fill the supply chain with inventory, in terms of the warehouses having inventory, retail chains having inventory, so you can actually open shop and say, here, buy the new phone, buy the new product. That's also under supply chain for the most part, because supply chain is going to determine, okay, where do we open a manufacturing plant, or influence the decision where things are going to be, how the things are going to be transported, all of those things. If you can manage those things better, you can bring more innovations to the table for customers and increase your revenues. Now let's look at the second driver of cost. This is kind of obvious. A lot of cost is under control of the supply chain department. Purchasing prices, the sourcing team, purchasing team under supply chain, hedging of purchase prices. A lot of companies which buy a lot of raw materials, like a lot of metals, like a lot of platinum, a lot of lithium for batteries, a lot of alloys, aluminium, copper, zinc, that sort of stuff. They will often try to hedge prices of these raw materials by getting into futures contracts. Again, what are futures contracts? Topic for the finance class. You can learn online from the internet if you want, but you can buy futures contracts. It's kind of like buying insurance. So if the price spikes of a raw material, the entire price increase will not be passed on to you. It's kind of like you've insured yourself against price jumps or spikes or increases in raw materials, right? So you can hedge purchase prices using futures contracts. You get transportation costs. How do you transport? Which mode? How do you optimize that? This is thoroughly covered in the logistics course I teach. So again, for details of transportation, you would have to take the logistics course. Inventory cost I covered in this course and the logistics course. So we'll learn more about that. It's going to be warehousing, pilferage, obsolescence, planning. How do we compute safety stock? All of that. And then administrative cost is also part of the cost. And this is not an exhaustive list. There are other costs, production costs, equipment cost, HR, the employee costs. So automation is going to influence this. How much automation versus labor. Outsourcing is going to influence this, whether you outsource production or produce in-house. So there's going to be lots of things that influence the cost. This is not an exhaustive list by any means. It's just some of the costs. Okay. Fixed assets. Okay, so how do we increase fixed asset turnover? Higher utilization of assets. If you have a higher utilization, less idle time, you can have a higher fixed assets turnover. And how asset heavy are you? Do you have lots of extra equipment, or are you leaner, and are you outsourcing some of the steps? Outsourcing can actually increase asset utilization for you and the company you outsource to. How is that possible? Isn't outsourcing just passing the assets to the supplier? No, it depends. The supplier may be able to use the equipment for multiple products, some of which you don't sell, and be able to utilize the assets at a higher utilization, because that one supplier may supply different industries or different companies, may use the machines in many different ways and have higher volumes and so forth, right? And so we'll talk about that a lot. We'll have at least a week or so we'll spend on outsourcing in this course, and we'll go into detail on how outsourcing can reduce cost later on in the course, but it can help you improve on this metric and higher utilization as well. Okay. And this is not an exhaustive list. Again, there could be other strategies which impact these metrics. This is just giving you some ideas on how you can map your supply chain manager's responsibilities to these metrics. Once you do that, the metrics take you to ROI and share price, and we have connected day-to-day strategic and tactical supply chain decisions all the way to the share price, which is very powerful, because then you can tell your managers, I did this is going to increase this driver, that's going to increase the share price, and you're going to get a nice bonus. So you are going to be happy, your boss is going to be happy, and you are going to be happy. Working capital, again, inventories, how much inventories you have, accounts receivable, how much credit you give to the customer, and accounts payable. Okay. Accounts receivable might not be as much in your control, because marketing might say, well, we have to give credit terms to the customer and so forth. So you might have to work with marketing on this, and then accounts payable is your negotiation with your suppliers. Okay, so this was a really powerful model. Why? Because it links supply chain management decisions to 4 drivers of value. The 4 drivers of value are linked to ROI and economic value add, and that is linked to the stock price. Major takeaways. Always consider impact of your decisions on all 4 drivers of financial performance: revenues, cost, fixed assets or fixed asset turnover, and working capital requirements. Supply chain decisions often involve trade-offs between revenues, costs, and assets. Okay. For example, you open lots of warehouses close to your customers, you can deliver to the customer faster. Faster delivery to the customer is going to increase your revenues. You may attract more customers, right? Revenues went up, but as a trade-off, your assets went up because you had to purchase equipment and facilities for those warehouses, and your facility costs went up and HR costs went up. You have employees there and so forth. So there was a trade-off. To increase your revenue, you had to kind of be worse on a little bit worse on assets and costs, I guess. But it also depends on how much revenue do these warehouses generate. Let's say you open a warehouse and your fixed assets go up by 10%, but your revenues go up by 20%, then this was a good deal, because your fixed asset turnover actually went higher by opening this warehouse. So it depends on the benefits you get from the increase in fixed assets and costs in terms of revenues, right? But it's not that everything will move in the positive direction. To get revenues to go up, you may have to have some costs go up, right? That is why you often hear from financial analysts that, okay, company is in a growth stage, so they're going to have higher costs, and so we can't look at profitability right now. Their profitability will improve once they get to the maturity stage, right? So whenever a company is growing, we give them a little bit leeway on costs, because we understand that to generate the revenues, you have to spend some money to generate the extra revenues in terms of facilities, raw materials, working capital, employees, equipment, so forth, right? Okay, financial metrics and quantifying them are key to C-level executives, right? So CEOs, CFOs, they love this stuff. They want to see the impact on financial statements. This can help you get their support, right? You can say, by opening this warehouse, my revenues will go up by this much, my fixed asset turnover will go up by this much, which means ROI will go up by this much. And so you can make them kind of happy and show them that this is actually going to be something tangible on the financial results of the company. If you're evaluating different companies, you're comparing different companies, make sure you compare companies in the same industry and companies which have the same strategy. Now that is a little bit flexible. No two companies may have exactly the same strategy, but broadly they should have the same strategy in terms of serving the same market. Okay, why? A company with a large product variety. Think of Amazon. They sell almost everything under the sun, right? So Amazon has a huge product variety. Amazon, that means they're going to end up having high inventory costs and low inventory turnover. So you compare Amazon to a more narrower retailer like maybe Target. Target doesn't sell a lot of things Amazon sells, right? Target's product variety is much less than Amazon. And you say, hey, Amazon managers are terrible. They don't know how to optimize the supply chain. Look at the inventory turns, which we're going to discuss next, or the inventory as a percentage of sales or something. You know, Amazon's inventory is so much higher than Target. Target is so much better, right? Well, no, you can't compare them. Amazon's strategy is to offer a huge product variety. Target's strategy is not to offer that huge a product variety. They have a narrower range of products. So that is going to lead to differences in inventory, right? And so sometimes it gets a little bit hard to compare companies, right? If they have very different strategies. A car company like Ford cannot be compared to a grocery company like Kroger, even though these metrics can be computed for both, as customers might be willing to wait for a bright yellow Mustang, but will not wait days to get milk, right? So Kroger has to have high availability of milk. Ford can have maybe one Mustang on display and then the other Mustangs get shipped later once the customer books them or something, right? So when you have very different companies or very different strategies, you can't really make an apples to apples comparison easily. So you have to be careful when you compare companies using these metrics. What you can always do is compare the same company over time. Is Amazon's metrics improving or not improving over time? And if they're not improving, is it because they have to make a large investment by entering a new market region or geographic region, or what's going on? Why are they not improving, right? So you can definitely compare the same company over time. You can definitely compare similar companies. You can compare Macy's and Kmart and Sears, perhaps. You could compare Target and Walmart, perhaps, right? Very similar companies. And so, you know, there are companies where you have competitors which are very similar and you can compare them to see which one. Home Depot, Lowe's, you can compare those two, right? Very similar strategies and companies. Not exactly the same strategy, but, you know, relatively comparable. So it'll be a very good idea to compare those two companies, for example. Okay, now let's look at some other financial metrics other than the ones we have studied already, these ones, which are going to help us evaluate the supply chain planning performance. Okay, supply chain planning has to do with forecasting, planning for inventories, determining optimal location of facilities, production planning, and we will spend a considerable time in this course, and if you take logistics with me in that course, doing planning. Planning is really important because poor planning leads to poor execution leads to poor financial results. Okay, so let's look at some metrics or key performance indicators that we can actually compute from financial statements, okay, which are publicly, freely available for public companies like Walmart, Target, and see how good their planning is. Okay, so let's look at these metrics. Okay. So we look at three metrics. One of them we already know, fixed asset turnover, sales over fixed assets. We already studied that. We already computed that for Walmart. So you can see it right here, right? Walmart's fixed asset over is $3.45, right? And so we already know that. So that actually reflects good planning. Why? Because it is impacted, this ratio is impacted by facility locations, by inventory management, okay? Two other ratios when I look at our inventory turnover ratio and GMROI, which is gross margin return on inventory. These two both have to do with inventory, and inventory management really captures your planning performance. Why? Because to be good at inventory management, you have to do better forecasting, and then you have to do better production planning and delivery of right inventory at the right place and all of that. So really all of your planning can show up in inventory related metrics. Okay, so inventory turnover ratio, it captures the effects of performance forecasting accuracy because that can lower safety stock, and the lower the safety stock, the higher the inventory turnover ratio. It captures the planning and inventory management and lead times. The gross margin return on inventory is efficiency of production and logistics. It captures pricing issues as well, forecasting accuracy, especially for seasonal item, responsiveness, how quickly can you respond to changes in demand, lead times, retail locations, ability to sell without deep discounts, and so forth, to a whole host of things that are related to planning. Some of these might not be like, pricing has to do with planning as well. As you'll see when we get to aggregate planning, if you're going to run discounts and so forth, you have to plan how they're going to affect your demand and how does that influence your inventory and so forth. So let's look at how do we compute these two metrics. Inventory turnover ratio, or inventory turnover, also called inventory turns, is simply how many times has the company replaced their inventory over a period of a year. So if you carry, let's say, $10 million worth of inventory and you sell $10 million worth of inventory over 2 months, then every 2 months you would have replaced all the inventory, right? Your old inventory would be gone and new inventory would have taken its place. If you're replacing inventory every 2 months, then after a year, you would have replaced inventory 6 times. So your inventory turnover is 6, right? So to compute it, you take cost of goods sold from the income statement and you divide it by the average inventory level from the balance sheet. How do we get average inventory level? Because the balance sheet, if you recall right here, the balance sheet only gives me inventories, not the average inventory level. Okay, so what we do is, this is the inventories at the end of the financial year. Okay, we take the inventories at the beginning of the year and we average the two, because if the beginning of the year they had less inventories, at the end of the year they had more, so approximately over the year they had a middle value between the two extremes, perhaps during the year. That's the best we can do with financial statement data. Okay, if this is a company that you work for, you can actually get a report from the database system which gives you the inventory level in each month or each week, and you can average all those numbers to get the average inventory level, right? But if you don't work for the company, all you have is the financial statements. You take the inventory from the most recent year, you take the inventory from the previous year, because the inventory in the previous year is the ending inventory of the previous year, which means that's the beginning inventory of this year, right? Ending inventory of 2017 is beginning inventory of 2018. Ending inventory in 2018 is beginning inventory of 2019, right? So we take inventory over 2 years, we average it to get the average inventory level. We take cost of goods sold divided by that. Okay. So for the Walmart case, I went back 1 year and I looked at the inventory from the 2017 financial statement. It was this much. 2018, it was this much. So the average inventory level during 2018, I take the average of the two, I get this much. Okay. Then for inventory turnover, I take cost of goods sold. This is given in the income statements, which you've already seen before. Divided by the average inventory level, I get 8.6, which is pretty good. So Walmart is replacing their inventory 8.6 times a year, right? And then average inventory days is just days, inventory days that we did for cash to cash cycle time. Remember here we did inventory days, DSI, days sales of inventory. That's the same thing that we're doing here, inventory days, right? It kind of turns out to be very similar, okay? Although the only difference is we're using average inventory level here, except just the inventory of that 1 year. We're using inventory, average inventory level from inventory over 2 years. That's the only difference. Otherwise, it's a very similar metric. You just take 365 days in a year, or you can take the years a business is actually open on. So some people will subtract holidays. They'll say, okay, 365 days a year, but Walmart is closed on this day and this day. So maybe 3 or 4 days of the year is closed. So maybe they'll take 360. Okay, sometimes people like to subtract holidays because a store can't get rid of inventory, cannot sell inventory on holidays. Right, so it doesn't matter, it's not going to make a big difference. So you take the number of days in a year, divide by the inventory turns, and you get how many days it takes on average to replace inventory. So Walmart carries about 42 days of inventory. Every 42 days, old inventory has left the system, new inventory has replaced it. Let's look at gross margin return on inventory. It is the gross profit earned per dollar invested in inventory. Think of inventory as an investment, right? Because if as a supply chain manager, there's many products you could build inventory of. Should I build inventory of this phone or that phone or that phone, right? So as you pick which products to invest in terms of inventory, then you have to look at the return of that, right? So the gross profit you earn for every dollar investment in inventory tells you about your production decisions, your sourcing decisions, how good they were. Okay, so how do we get gross profit? It's simply sales or revenues minus cost of goods sold. Both items are in the income statement. They're usually the first two lines on an income statement, right? So look at the income statement. First line is sales. Second line is cost of goods sold. You subtract the two numbers and you get gross profit. Okay, that's this part. So you get that. Okay. Then average inventory level, we already saw how to do that. You take inventory level from the year you're evaluating, that year's balance sheet. You go to the last year's balance sheet, take the inventory level from there, average the two. You have average inventory level. You divide the two, you get GMROI. Let's do this for Walmart quickly. Average inventory level, we already did this in the previous slide as well. You take the 2018 balance sheet, you take the 2017 balance sheet, and you get the average inventory level of 43,414. Gross profit for 2018 is sales minus cost of sales or cost of goods sold, 126,947 million. You divide that in millions, this is also in millions of dollars, this is also millions of dollars. You divide the two, you get 2.92. So Walmart earns $2.92 in gross profit for every dollar invested in inventory. That's pretty good. They're tripling their money. They spend $1 to build inventory. That inventory, $1, they invest $1 in inventory, and that inventory gives them $3 of gross profit. Gross profit means the inventory pays for itself. The $1, they give you $3 extra, right? Because you've subtracted the COGS already. So every dollar investment in inventory that Walmart is doing, they're making $3 approximately off that investment. That's really good. The reason GMROI is really so important, is so crucial for supply chain planning is this. Anybody can make a lot of stuff, right? Buy a lot of supplies from the supplier, produce a lot of stuff, hire workers, give overtime, buy machines. Okay, it's not that hard to produce a lot of stuff. But sometimes it is if your supply constrained, but in many cases you can produce a lot of stuff, at least over time. Okay, you can also sell a lot of stuff. How? Give deep discounts, right? Cut your price by a whole lot. Keep driving your price down and down and down, and your sales will go up because people like, cheaper stuff. They think it's a good deal. So inventory turns could be, or inventory turnover ratio could be inflated by giving deep discounts to customers and making a lot of sales and a lot of production, doing a lot of production, doing a lot of sales, but you might not be making a lot of money. In fact, a company could break even or make a loss, but still have high inventory turnover. That means their supply chain planning is not really good. They're losing money, they're bleeding money, but still they keep making stuff and selling it, right? So gross margin is saying you have to not just make something and sell something, you have to be smart. You have to sell stuff that makes money. You have to earn gross profit on the stuff you are selling. Okay, so this is harder to just inflate by giving deep discounts than inventory turnover ratio is. GMROA is very commonly used in the retail industry to compare. You can calculate it for different retail stores, for different geographic areas, for different product categories. Okay, if you're a retailer, you can say of shoes, you can say women's fashion shoe give me a lot of GMROI. Okay, and men's work boots don't give me any GMROI. They don't like to buy the newest style. They buy the same old black shoe all the time. Okay, so you might say, well, I have some working capital. Where do I put it in? And you might make more women's fashion shoes than men's black shoes. I'm just making it up. I don't know which one gives more GMROI, right? But that's the kind of thinking you can do in your supply chain planning to maximize GMROI. It's an important metric, especially in retail supply chains. Okay, so we covered these three metrics to evaluate the performance of just the planning part in supply chain management. Now, that all of what we have done till now, we just looked at financial statements. Okay, and now we're going to look at performance metrics for supply chain that are only known internally within the company. So you work for your company, you can calculate these metrics, but outside people don't know these metrics because these are not reported on financial statements. Okay, so I have summarized all of these metrics on this one slide. it may be too small for you to read it in the video, but you can always download the slide, print it out, increase the font, do all of that. Okay. Now, which metrics are more important than the others? Which one should you focus on? Would depend on your supply chain strategy. Because remember, if you go to the supply chain strategy lecture, that's going to help you pick how responsive or efficient to be, where to be on the responsiveness efficiency scale. If you have to be very efficient, you're going to focus more on the cost and less on the customer service part, like responsiveness, higher fill rates, higher product availability, right? If you're more on the responsiveness part, you're not going to care about cost as much. You're going to care more about responsiveness to the customer, having inventory available, things like that. So which metrics in this huge table are more or less important depends on your strategy. I'm just going to give you some important metrics for 6 different areas of supply chain management. And then, within each area, within all 6 areas, which ones do you prioritize is going to depend on your supply chain strategy. Okay. And if you take this course, by the end of the course, a lot of this will become more clear. And if you take logistics course, it will also become more clear. Okay, because when we go into details of these areas of supply chain management, you'll learn more about, why this metric is important, how to improve this metric, and so forth. This is just a high level view. The goal right now is just to kind of know some of the important metrics and to have some idea of why this is important. But if you don't understand completely, that's not too bad. That's fine. You learn more as you go on. Okay, so I've divided supply chain management into 6 areas. Facilities management, do everything to do with facilities, including manufacturing plants, warehouses. We talk about managing manufacturing in the operations management course. We talk about managing warehouses, distribution centers in the logistics course. So a lot of this facility stuff is covered in other courses, operations management and logistics, and not per se in this course. Okay, but you will learn some of this stuff. So utilization. Okay, you talk about this in line balancing and all that stuff in operations management. Idle time has to do with utilization. The higher the utilization, the less the idle time there is. You can compute idle time for equipment and labor. You want this to be high if you are trying to be efficient. If you're trying to be responsive, you want to have excess capacity. So you want to have you want utilization to be high for efficiency, but for responsiveness, you don't want utilization to be very high. You want utilization to be a little bit low. Well, not low, but a little bit low, because you want to have some excess capacity to have that responsiveness. Quality, what is your flow cycle time, desired versus actual? How much product variety are you processing? Again, if you want to be responsive, you may have a higher variety because you're being responsive to customers' demand. If you're being efficient, you may cut down the number of SKUs to be more efficient, right? Batch size. Bigger batch sizes can sometimes lead to efficiencies, but low on responsiveness. Smaller batch sizes can give you more responsiveness, but less efficiency. So again, where you want to go with this metric depends on your strategy. Product service level, percentage of orders completed on time in terms of production, that would be also come here because that's part of production planning for facilities. Inventory management, cash to cash cycle time. We did this today in detail, what it is. It talks about it. This is basically working capital management for inventory, right? Because the lower the cash to cash cycle time, the less working capital you need. And lower is better for cash to cash cycle time. Because the higher the cash to cash cycle time, the higher the investment you need in inventory. Inventory turnover, fill rate. This is fraction of demand supplied on time. So if a customer comes to buy 10 units and you have only 9 on hand to sell him, your fill rate was 9 out of 10, 90%. If the customer comes to buy 10 items and you supply all 10, your fill rate was 100%, right? So it's the percentage of demand you can supply from inventory or within the time the customer gives you. Gross margin return on inventory, we already covered in detail. Fraction of time SKUs are out of stock. So once you do go out of stock, you don't have stock or inventory of something. How long do you stay out of stock, right? So think about the COVID-19 issue that happened. There was shortages of toilet paper, okay? So we were, retailers were out of toilet paper. So what mattered was their fill rate was low, their availability was low. But what also mattered was how long were they out of stock? Were they out of stock for 4 weeks, 6 weeks, 8 weeks, or the whole year, right? That also matters. Transportation, we're going to look at shipment sizes and costs, both for outbound and inbound. So what is the inbound shipment size and cost on average? What is the outbound shipment size and cost? You want to carefully track the shipment sizes and cost because they're related. If you are sending many, many small shipments, your transportation cost will go up. But again, if you're sending few large shipments, your lead times could go up, right? Because you're waiting to fill up the truck and so forth. So there's a trade-off there, whether you want to be responsive with low lead times and you want to be efficient. Depending on that, you want to track the shipment sizes and costs for outbound and inbound shipment. Fraction of units moved by each mode. Again, this is covered in detail in logistics. Different transportation modes have different costs. Air is very expensive. Truck is cheaper than air. Rail is cheaper than truck. So, if you are trying to be efficient, and you are shipping nothing by rail, you might want to reevaluate that, right? Well, I'm not using any rail. Rail is the cheapest mode, or ocean freight is very cheap, but I'm using air. What's going on, right? So depending on your strategy, you want to match the modes of transportation to that. Forecasting planning, forecasting error. Okay. Again, operations management covers this in more detail. If you've not taken that course, we will cover forecasting a little bit in this course as well, but more details in operations management for that. You can't cover everything in one course. It's just impossible. Supply chain management is a very broad area. Okay, frequency of update. How often do you update your forecasting? MAPE, by the way, is just mean average percentage error. It's just the percentage amount your forecast was off from the real demand. So if your MAPE is 10%, your forecast is going to be within 10% of the actual demand. Okay, ratio of demand variability to supply side order variability. This is a little bit tricky to understand. Okay, what this means is your demand that your company sees might be variable, and over time the orders you place to your suppliers are going to be variable. The quantity is going to go up and down, right? You don't order the exact same quantity at the exact same schedule to your supplier. Sometimes you order more, sometimes you order less. Okay, so you want to make sure that the variability in your demand, the variability on your supply side is not more than that. If your order, let's say the variability in your demand is plus minus 20%, your demand goes up and down month to month plus minus 20%. Okay, but the orders to your suppliers are plus minus 50%, then that's not really a good match, because your demand variability is not very high, but somehow you have increased the variability for your supplier. So you don't want to do that. Okay, and then variance from plan. If you had a plan to produce in a certain schedule and have certain inventory levels available, how far are you from the plan in actual? Sourcing, purchase price, obviously, range of purchase price for a particular SKU or SKU family. If you have a high range means variability, minimum minus maximum. If your range is too high for an SKU, that means sometimes you're paying too much for that SKU, right? Because the price is moving up and down all the time. Or you're not mitigating the risk of price changes. If it's a commodity like a metal or raw material, you're not insuring against the risk of commodity prices by using different types of financial contracts. So you don't want the range to be too high. Purchase quantity, how much do you purchase? You want to track this over time to make sure you don't purchase a lot and then nothing. Maybe you want to see whether that is the best strategy or not. Quality of the purchase good, what's the defect rate? You don't want to have suppliers with a lot of defects, that's obvious. Lead time for your purchasing, percentage of on-time delivery, days payable outstanding, what are the payment terms you have with your suppliers. Revenue management has to do with profit margin, how low your costs are compared to the price you can charge. Are you giving credit to the customer or not? Days sales outstanding, the lower the better, because the less the working capital you'll need, right? Days sales outstanding and days payable outstanding are both part of cash to cash cycle time. They increase cash to cash cycle time. So go back to those slides if you're not sure how. You'll see they're part of cash to cash cycle time. So these two need to be kept. Well, no, this reduces cash to cash cycle time. So the more days payable outstanding you have, the more the supplier finances your working capital. So this is good for cash to cash cycle time. This is bad. So you want this to be low and you want payable to be high. Sales price, sale price, not sales price like a discount, but the actual sale price, right? Now you might say, well, marketing sets the sale price. Not entirely true. Well, it is kind of true, but supply chain also have some influence. If you provide a high level of customer service by fast delivery and so forth, you have more opportunity to charge a higher price from the customer, right? And the service you provide to the customer, the supply chain has influence over that. Range in sale price, do you keep the price the same over the year or does it go up and down? Again, depends on your strategy. And also, the price going up and down can have some effects on the supply chain, because as the price goes up and down, the demand will go up and down, and price variability can lead to demand variability. We'll discuss this more when we talk about aggregate planning on how that happens. Okay. Range in sales quantity per month or week. That is telling you how seasonal your sales are. Are some months really high sales and then low sales in other months? Think about companies which sell costumes. Okay, the company that sells Halloween costumes, the sales go up extremely Halloween time, and then they fall drastically rest of the year. Why is that important? Because if you do have that sort of seasonality, your supply chain planning and management needs to reflect that. Average customer order size is the customer buying small items or larger orders, and number of unique customers you have, number of new customers you have, and number of repeat customers you have. This is very important because you may be losing customers and not gaining customers, right? And you may not notice quickly, but if you're tracking these metrics, you'll see, okay, these few months I've had no new customers. What's going on? Or very few new customers. And repeat customers are decreasing because I'm losing customers. So what's going on, right? So you want to track your customer base, how it changes as well, because that could change their preferences, which products they want. And this could be a reflection of your service in terms of delivery performance, response time. If you don't have good service, supply chain related service, that could be affecting why customers are leaving. Okay. Now there is the reading associated with this topic that you're required to do, which is called Hierarchy of Supply Chain Metrics. I think it's a very useful reading. I'm going to summarize some of the main ideas here, but I highly recommend you go and do the whole reading. So the central point of this reading is looking at this triangle. Okay. Okay. So at the top of the triangle, the peak, it says is demand forecast accuracy. What that's telling you is that's the first thing you need to improve on, because that's going to impact your second level of this pyramid, the cost there, right? So if your forecast accuracy is really bad, then you have to have a high safety stock that's going to increase your supply chain cost. If your forecast accuracy is bad, you're going to have lost sales, which will decrease your perfect order. Okay, a perfect order is defined as customer wanted something and you gave it to them on the customer's terms. If the customer wanted it today, you gave it to them today. There was no back order, there was no stock out, there was no late delivery, there was no damaged good delivers to the customers. All of these things that happen or can happen means it was not a perfect order. Perfect order means customer gave you demand, gave you order, you did perfect execution in terms of quality, in terms of time, delivery time, in terms of having it in stock. All of that was perfect. So what percentage of the orders you get are you able to serve in a perfect fashion without anything going wrong? That's the perfect order metric. Okay, cash to cash cycle time, we know we've done this, and supply chain costs, we have an idea what those costs are. We'll cover this more in this course, facilities costs, transportation costs, manufacturing costs, so forth. So what the reading is telling you is all of this, supply chain costs, cash to cash cycle time, which is a reflection of working capital, and the perfect order, all of these are impacted by forecasting accuracy. Showing you the importance of forecasting, right? And by the end of the course, you should be able to explain in your own words why. Why does forecasting accuracy impact perfect order, cash to cash cycle time, and supply chain costs? You should exactly understand why by the end of this course, okay? Briefly, if your forecast accuracy is low, you're going to have buffer inventory and or buffer capacity. Buffer inventory will increase your working capital requirement. Buffer capacity will increase your production costs. Buffer inventory will also increase your inventory costs. The more unpredictable the sales, the more stockouts you'll have and lost sales you'll have, so that's the perfect order you'll have. Now, the second level is going to affect or be influenced by the third level. So your procurement costs are part of supply chain costs, so that's obvious. Manufacturing cost is part of supply chain costs, so that's obvious. Inventory cost is part of supply chain costs, so that is obvious. Procurement cost includes transportation costs as well. So all these are costs which are going to lead to supply chain costs. Supplier on time is going to impact perfect order. If your supplier didn't send you stuff, how can you sell it to the customer? Supplier is delayed, your order to customer might get delayed. Supplier quality is going to impact perfect order quality, because if the supplier quality is poor, garbage in, garbage out, you put in poor parts, you get a poor product out, you lose perfect order, okay? Working capital. If the supplier has quality problems or takes a long time, your working capital requirements will go up. If your inventory costs and procurement and manufacturing costs are high, that means your inventory costs will be high, your working capital requirements will go up. So it's a very nice pyramid. The lowest level leads to the second level, and the second level is really impacted by the first level, right? So it kind of shows you the relationships between various metrics in one nice picture, okay? Okay, tips on using this hierarchy. Demand forecast accuracy determines the trade-offs between perfect order performance and supply chain costs, right? You could get perfect order by having huge inventories, okay? But if your demand forecast is really accurate, then you don't need huge inventories to get perfect order, okay? You know, how accurate your top of the pyramid is going to influence how costly it is for you to have perfect orders. Like, you know, fulfill all orders perfectly. With unpredictable demand, it is expensive to have high perfect order performance. With predictable demand, you know, high perfect order performance at low cost is possible. So often there is room for improvement in forecasting. That is one area where a lot of companies can improve in. Cash to cash cycle captures working capital requirements. Supply chain costs can be broken down into various components, and supplier quality and on-time performance directly influence supply chain cost. This is important because sometimes the problem is outside your organization. You've been trying to make your supply chain efficient, trying to cut down on costs, but you just can't do it. Check your supplier's performance. You know, do they have long lead times? Are they delivering pieces with problems and defects, right? Now, one question that arises, well, all of this is very understandable for a make-to-stock environment, right? Make-to-stock is you go to Walmart or Kroger, goods are already ready to be purchased, right? They were already produced before you walked into the store. So before the customer arrives, the stock has been produced and is ready for sale. That is make-to-stock. Make to order is the opposite, where the customer arrives and places the order and then something is produced. Imagine you go to a high-end steak restaurant, and when you go sit in the restaurant, you place your order, then the cook will go and cook the steak. So the goods are produced after getting the customer order. That's make to order. So does this pyramid apply to make to order? Is there any forecasting to do for make to order, right? So we covered this issue a little bit in operations management as well, but the basic idea is, yes, you have to forecast capacity requirements. Restaurant has to know how many people will show up or are expected to show up, because it has to have seating for that many people, has to have meat, vegetables, sauces, inventory for that many people. So even though you cannot forecast exactly which menu choice a customer will pick, or you may not forecast that. You still have to forecast an overall demand number, and you still have to break that forecast into what capacity is required, what raw materials are required. So even in make to order environments, demand forecast accuracy still is important, because that drives all of your supply chain planning. And if that is bad, that's going to be the bottleneck for all your supply chain planning. Okay, so that is all. Hopefully you now have an idea about how to use financial statements to analyze companies' supply chain operations and their financial performance, and from a supply chain perspective. You have an idea of how to evaluate supply chain planning using inventory turnover, GMROI, and fixed asset turnover. You have an idea of key performance indicators in 6 areas. Each column is a different area of supply chain management that companies can use internally and keep track of these metrics over time. Which metrics you focus on will depend on your strategy. Okay? So if anything is unclear, a lot of these financial terms like cash to cash cycle time, you can always Google them. You can always reach out to me for a more explanation.